Good morning, everybody. I'm Sarah Lover, Business Development Coordinator with Atlantic Bay Mortgage Group. Today's presentation is brought to you by RVAR's Education Committee. We've got a few committee members in here today. So this is a hybrid class with obviously people in here, and we've got some Zoomers. Laura Benjamin is joining us from her office so that she can monitor those joining us via Zoom and send over the questions. For those of you that are in the room, we've got the microphones installed in the ceiling if you can see them. And so they're very sensitive, so you can kind of keep your noise to as quietly as possible and refrain from speaking because we are recording this too, and it'll show up on the recording. And please make sure to mute your mobile devices. And for those of you on Zoom, please remain muted until you would like to pose a question. So after each presentation, we will have some time for Q&A. And for those of you on Zoom, you can either type that in the Zoom chat which Laura is monitoring, or you can unmute yourself and ask. We'll also obviously let you all in the room throw questions at these beautiful people up here. Before we get started, let me mention the next class being offered by RVAR's Education Committee. That'll be on May 24th. We have Environmental Hazards, focused on asbestos, lead paint, mold, and buried oil tanks. This is a free class, which will also be available in hybrid format with up to 35 attendees in person and others via Zoom. For those of you here today, there should be a flyer so you can register while you're here today, or you can do it online at the rvar.com. And don't forget our spring golf tournament coming up May 13th at the Botetourt Country Club, and you can register for that as well on rvar.com. So here are our three presenters. We've got David Hypes, the truest. David entered banking in 1980 and landed in the mortgage field in 2005. He has been with Truist Bank or its predecessors his entire banking career. That's great. And then we have Miss Jamie Bailey of Alcova Mortgage. She has 24 years experience as a loan officer. She has been with Alcova since 2004 and currently serves as a branch partner, manager, and loan officer for them. And then finally, we have Mr. Adam Johnston of Member One Federal Credit Union. Adam has also been working in mortgage and finance for 24 years. He currently serves as the Vice President of the Real Estate Lending Department at Member One. And all of our presenters, as well as myself, are members of the Education Committee. Today's presentations were created by each presenter and reflect their views, opinions, and experience, and do not reflect necessarily the views, opinions, or recommendations of RVAR. We're recording this class today, and we'll make it available for you all for a 30-day period. And we'll also be sending out a survey to all attendees. And if you don't mind filling that out, that helps us just know what's important to you all so we can be presenting that content to you. All right, I'm gonna hand it over to Mr. David.
Thank you, Sarah. Appreciate your assistance with us. Good morning, everyone. Very happy to see people in real life and not just on a camera and looking at a computer screen. So it's good to be back together again. Mortgage is a journey. It's a road trip, and we're going to take you from the beginning of the journey all the way through to the end to our destination, which is getting our clients, yours and ours, into their new home. As we all speak today, we will be talking about things from a kind of a basic level. Each lender has a little bit of a different way to do things, but these concepts that we're going over are going to be pretty basic to any lender that you're working with. So let's buckle up for our journey. So I'm going to be talking about pre-approvals and how they can be of help to you and to us and to the lender, to the borrower. What is a pre-approval? Well, during a pre-approval process, we're going to look at two major areas that can have an impact on how that loan moves forward. The first one is credit. We're going to pull credit. We're going to look at credit scores. We're going to look at, see what their total debt load is. We're going to be able to address any derogatory or negative information that's on the credit report so that we can take care of that up front. find out the why behind why was that credit troubled at one time. Another thing we're going to do is do a debt analysis. We're going to make sure that the payment for the new mortgage is going to fit in their monthly cash flow and in their household budget. We do that by computing a debt ratio. Now, what that is, all it is we're taking the existing debt that person has off of the credit report, adding the new house payment to it to see, do they have adequate income to cover that? Rule of thumb, 43% is the maximum debt requirement, debt ratio requirement. If you have less debt than that, and the debt ratio comes in lower, that's great. What it does for us as lenders, it helps us to guide our clients into what they can comfortably afford. If the debt ratio comes in low, then that tells us, okay, maybe you can afford more house than you're thinking about. Because initially, no one really knows. They come to us and say, I don't know how much I can afford. I don't know what I should do. That helps us to guide them into where their comfort zone is. So they'll know how much house they're looking for. By the same token, if the ratio comes in high, you might need to scale back your expectations and look a little bit in a lower category. So something that helps you to picture all this. I'm a kind of visual person. Think about the mortgage as a three-legged stool, okay? It's got three legs and it's standing there. And if one of those legs is not there, that stool's going to fall over. So what are the three legs? We've talked about one, credit. That's imperative. We need to make sure that the credit's good. Two is capacity. That's your debt ratio. Do they have the ability to pay the payment that we're projecting? The third leg is collateral. That's where you all come in, the house. Lenders are not, lenders do not want to foreclose on houses. Lenders do not want houses on our books. So we're not looking at collateral from the standpoint that if they fail on the mortgage, then we're going to foreclose on the house, because we don't want to do that. But we have to make sure that the value is there for the mortgage that we're providing. So when we're looking at the documents that will be needed during the loan process, and sometimes for a pre-approval, we're looking at things like things that can prove that income that that client has told us. Clients are sometimes vague, no. Sometimes clients are uncertain. And so we ask for documentation so that we'll know exactly where does your income lie. So the types of documents we would look for if you were an employed borrower would be W-2s, pay stubs, those sorts of things. If you're retired, we would ask for your bank statement showing your direct deposit of your Social Security, annuities, pensions, whatever. We would also ask for the 1099s that they would get at the end of the year for those sources of income. And lastly, self-employed borrowers. Now, they can be a challenge sometimes, but the things we would need to see would be tax returns. That's the only documents that would be able to tell us what their true income is. So personal and business returns, usually for 2 years. The same goes for rental property. If they are landlords and rent properties, regardless of whether the subject property in this particular loan is going to be a rental property or a primary residence or a second home, we still need to know about that income from the rental properties. So cash, no cash, never cash. If they've got a bucket of cash and it's under their mattress or it's buried in the backyard, they need to get it deposited as quickly as possible, because we cannot use cash in a transaction. So it needs to be put into an account and properly aged so that it is there at the beginning of a statement period and it doesn't appear as a big deposit, because that could raise some red flags. We also need asset documents to show that they have the funds to meet closing, that they've got down payment and closing costs. So that can be satisfied with checking, savings, investments, gifts from family member, those sorts of things. So why is, yes?
What is the rule of thumb in terms of putting cash in the bank typically? So if you had a cash buyer, it was buried in the backyard.
Mhm.
How long do you guys want to see
It
it?
needs to be in there at least a month, a
At
full
least a
statement period prior, so that the beginning balance on that bank statement already includes it. We don't want to see large deposits hitting. The question would be asked by an underwriter, what was that? We say cash, and they say, yeah. So why is doing a pre-approval or pre-qualification important? It helps you know that the client can get a mortgage. They've already talked to somebody. They've already ironed out any questions they have about the mortgage process with a lender. It also helps you to know the price range that you can show. As we said, we're going to guide them into what fits into their budget. It helps the loan file to move more quickly down the road. Any obstacles that we're going to run across can be uncovered in this pre-approval process. And we're going to iron those things out so that we're not fighting with the contractual deadline of closing. So those things can really help the process go much smoother once we're under application. So let's get away from pre-approvals now and jump into interest rates, everybody's favorite topic right now. So we know we're in a extremely unique time in our history. Rates are rising rather violently sometimes. I looked at the interest rates last night as I was preparing to speak today, and I just put in a plain vanilla $250,000 purchase, $200,000 loan amount, 80% loan to value, 30 years fixed was running about 5.5, and that was with no points. I'll talk about points in a second. And then if you wanted to pay 1 point, it was right at 5%. So the days of 3% are gone for now. And I know that's going to be some sticker shock, to folks as they consider their option. ARMs are even worse. In history, ARMs would usually be better, but a 10-year ARM was running at 5 3/4. So, and then a 15-year even is at well over 4.5. So that's the world we're in right now. I mentioned points. What points do is you're basically just buying down your interest rate. Okay, you're going to pay a fee up front on the loan closing costs that will enable us to provide a lower interest rate. It's called a point. 1 point is equal to 1% of whatever the loan amount is. So it's going to move as the interest rate moves. As the loan amount moves. They're not all one. It could be 3/4 of a point, 1.5 points, whatever. But in the past, we would usually tend to go towards 0 points. Why add fees to a borrower when they're already, paying closing costs, they've got a down payment, they've got other things coming off? Why do that? And so the answer was often, well, let's go with the 0 points because the rate was competitive. Now, I would recommend paying a point and seeing what does that do, because the spread, as we saw when I gave you those rates, it's about 0.5% on rate. When you pay a point, you get a better rate by about 0.5%. So it's worth the exploration of doing that, so that the long term, the 30-year, you've got a much lower interest rate than you would have had if you did not pay those points. So that's something that the lender has that conversation with the client about how to proceed. And if we're going to take questions when
Yeah.
just hold on to that thought. Rates change daily. Rates change within the day. I might give you a rate this morning. This afternoon, it's not. So the only way we can lock is once the property is under contract. We can't lock on a pre-approval because we don't have a property. We don't have a closing date. We don't know how long it's going to be. So we need a contract. We can lock for 30 to 45 days. We're going to try to match your close date in your contract. We want to make sure that our rate expiration date goes beyond the close date, so we don't have a rate expiring. We don't have any last minute headaches and heartburn. I will say that and this is a big caution, if you have a client that they have been pre-approved and it's been, let's say, more than a week, they need to keep in touch. I tell all my clients, keep in touch with me. Rates are changing, rates are moving. And the reason that's important is, let's go back to that conversation about debt ratio. If they're borderline, let's say they're 41% on their debt ratio, and because of rate increases, now all of a sudden their debt ratio is 45%, that would be a problem. We would have to drop back on the purchase price that they're looking for, because the mortgage that's driving this, it would have to be lower. So the takeaway on that is, and like I said, I tell my clients this, but remind them, anytime you're getting ready to make an offer, be sure, if not more often, keep in touch with the lender to see where rates are, because it's so volatile right now. And I also advise clients that a pre-approval is very much like a credit card. You're given a limit. That doesn't mean you have to spend that much, but let's go for the most that you think you possibly would be comfortable with. And then you know that if you find a house that's $5,000 more or 10,000, whatever, you know you're okay with it. You know, you've got that freedom, that wiggle room to negotiate. I have provided letters in multiples of $5,000 in this environment. For example, they were approved for, let's just say 200,000. So they wanted to make an offer for 195. And so I said, okay, I'll get you a letter that says 195 so you can use with your offer. I'll also do you one for 200. I'll do you one for 205. I'll do you one for 210. So that as those negotiations are going, they've got it in their pocket that they can pull out. Yep, we can do that. Yep, we can do that. So that way they're able to be able to not show their whole hand to the seller, to know that, hey, he could pay 300,000 for this $200,000 house. We don't want to do that. So I can give them multiple. We can give them multiple letters to show that they can have negotiation room.
All right, does anybody have questions for David at this time? We'll have questions at the end too, but while we've got David in the hot spot, we want to have questions.
So I had a
Yes,
question
sir.
about the points.
Yeah.
Is there a mathematical, has it been figured out mathematically at what point you need, how long you need to stay in your house before that point becomes worth it or not?
Good question. And that,
I'm sorry, do you mind repeating the question? That way people understand.
okay, sure. The question is, has there been a way to determine how long the
Homeowner, buyer.
the homeowner would be beneficial to pay the point as opposed to not paying the point? And basically that is something that there is no real hard and fast rule or figure, and it depends on the amount of the points between, that you're paying. What I like to do is show the client both things. I show them one without points, show them one with a point, just to demonstrate. And then I do the comparison. Okay, you're going to save X amount with that lower interest rate. So your monthly payment is this much lower. How long would it take you to recover that point that you paid up front? 2 years, 3, something like that probably would cover it. After that, you're in the gravy. After that, the lower payment is the, you've repaid the cost of getting that rate by that point. So that's all part of our conversation.
I got a question.
Yes, sir.
The rate lock fee that you mentioned,
Mhm.
is it possible for the buyer to purchase a rate lock fee up front before they find a home for X amount of dollars? And if so, is that tied to a specific price point to get that rate lock? Do they have to stay within a certain point, or can it be any value of home they buy?
Okay, the question was about buying or paying a rate lock fee and how it can be determined prior to having a property. Some lenders don't charge a lock fee, some may. So that would be subject to having a conversation with that particular lender. And there really is no way, and from conversation with my teammates here, there really is no way to lock a rate without a contract, without the house being under contract. There's really no way to do that.
It could be very costly to extend even if you did, like,
So even if we did lock one for 30 or 45 days, the longer you lock a rate, the higher it's going to be. So we're wanting to keep it as short as possible. So if you lock a rate for 30 days and you haven't found a house by day 10 or 15, we're in trouble. And so we're going to have to extend that lock, and that can be very costly. Yeah, thank you. Yes, sir.
For your debt ratios, is that for FHA or conventional?
That's the standard, and I believe it does apply to FHA as well.
That's the back ratio.
Mhm. Yes, sir. Yes, sir. There are two debt ratios. One's a housing ratio, which is just looking at the cost of the mortgage versus income. Then the back ratio is your entire debt scene. That's the one that really drives it. That's the 43%. So you may have a housing ratio of 25%, but your back ratio, your total debt ratio is 43%.
All right. Thank you, David.
Thank
And
you.
if you have any more questions, just remember we'll have time at the end and you can ask all our panelists. We'll hand it over to Ms. Cheney.
good morning, everyone. I'm going to go over some basic loan program concepts without digging too deep into underwriting. And before I start, I kind of want to go back to the last question on the debt to income ratio, because this is very important. As lenders, we have to run the loan through automated underwriting, which is basically a computer which analyzes the loan file and determines what is acceptable and what is not. And of course, it's reviewing all the aspects of the loan: credit score, debt to income ratio, loan to value, reserves and assets that the borrower may have after closing. So while David gave the 43 general, that doesn't necessarily mean that we can't go higher. It just depends on the actual borrower and their strengths or weaknesses. So I'm going to start out with conventional mortgages. These are loan amounts that go up to $647,200. Typically, these require a 620 credit score or higher. On these types of loans, the seller can pay 3% in closing cost. Regular conventional down payment is 5%. There are also conventional products such as Home Ready. I don't know if you guys have heard of Home Ready, but Home Ready is a very nice feature for buyers. It allows 3% down, and it typically has a reduced mortgage insurance option on the loan. Usually the caveat, if you're buying a higher priced home, if the seller's only paying 3% in closing costs, sometimes they're not paying all closing costs, and sometimes borrowers need those closing costs. So that's sometimes a downfall on these conventional products. With the Home Ready product, the borrowers have to qualify under median income limits, which is $75,400 yearly. So they cannot make any more than $75,400. The advantage to the conventional loan is that the mortgage insurance does drop off at 78% loan to value. The borrowers can actually request to have the mortgage insurance drop off at 80% loan to value. And to do that, they actually have to contact their mortgage servicer. They have to pay for what's called a broker price opinion or an appraisal. Usually the broker price opinion is cheaper. If the value comes in acceptable, then they will drop the mortgage insurance. I've listed maximum debt to income ratio as 50% on a conventional mortgage. And I'm going to tell you, this is very unusual. It usually does not happen. Usually on conventional, 44.99 is usually the highest you're going to get. I actually ran a loan file 2 weeks ago and I got an approval at 48% debt to income ratio. When I looked it up, it said can go up to 50. I wouldn't expect this though. That's not really typical. You must have a strong borrower to get over 44.99% debt to income ratio. Conventional is where you will also find investment property loans. These typically require a 660 or higher credit score and 15 to 20% down payment. On investment property loans, the seller is limited to paying 2% in closing cost. Under this, we have high balance loans as well. These loans are purchased by Fannie and Freddie. These are loans above the conventional loan amount of $647,200. They go all the way up to $970,799. 620 or higher credit score. Usually on high balance, they're looking for higher scores. I mean, you're going to have a borrower with a lot of good compensating factors if you've got a 620 score on a high balance loan. 5% is the minimum down payment. Then we have non-conforming jumbo loans. These are loan amounts higher than $647,200. There's no maximum loan amount on a jumbo loan, but each lender decides their appetite for these loans. So from lender to lender, you could have a variance in credit score requirements, down payment requirements, etc. Usually down payment is at least 5%. Could be higher depending on property usage, meaning if it's a second home or an investment property, they're probably going to have to go to 10% down. FHA is our next product. It is a government product, 3.5% down payment. They will do loan amounts up to $420,680. This loan has an upfront funding fee and monthly mortgage insurance. So the upfront funding fee is typically added into the loan and finance. The borrowers do not pay this. A lot of times it will show up as a closing cost and they get very confused as to, are my closing costs really high? They're not. It's the funding fee that's financed in. They also have monthly mortgage insurance. With FHA loans, if you're doing a 30-year fixed rate mortgage, the monthly mortgage insurance is never going to drop off the loan. It stays on forever. FHA is looking for credit scores of 580 and higher. With that being said, at 580, the buyer is going to have a lot of compensating factors. They're going to have assets, reserves, long job time, low debt to income ratios. There's going to have to be some offsetting feature to get that loan through automated underwriting on a 580 score. FHA loans are typically more flexible than conventional loans. They allow for a higher debt to income ratio. I've seen them go up to like 54.99%. And a good feature of FHA, if borrowers need closing costs, let's say it's a low loan amount, like $100,000, the seller can pay 6% in closing. So usually you're covering everything that the buyer needs in closing cost. Our next loan program is USDA, and that's 100% financing. It's available in USDA designated areas. So the house has to be located in a USDA determined eligibility area. Seller can pay all closing costs. 620 score is the typical required. This loan also has an upfront funding fee that is financed in and monthly mortgage insurance. And USDA is pretty strict on their debt to income ratios. Mortgage insurance never drops off on this loan. The USDA loan is an excellent choice, and typically it will give the client a lower payment than an FHA loan. But because their debt to income ratios are stricter, you're usually not going to get the client approved to purchase as large of a home, as large of a purchase price amount on the home. VHDA is actually a state agency program that assists buyers with down payment or closing costs or financing on any of the above mentioned products, except for jumbo, high balance, and investment. They do not lend on those types. There are income limitations that the borrowers must meet depending on the program used. Maximum sales price in our area is $295,000, and USDA will not go over 5 acres. That's very important. I'm sorry, VHDA will not go over 5 acres. That's very important to note because some people overlook that. Then we have reverse mortgages. These are mortgages for persons age 62 or older. This product allows seniors to actually purchase or refinance a home. A lot of people don't know that you can use a reverse mortgage on a purchase, but you can. There's no required credit score. Loan to value is actually based on an algorithm. We have to plug the information in and it tells us what we can do. Typical loans are 75% loan to value or less. It's going to be dependent on the person's age. And with the reverse mortgage, the client never makes a mortgage payment. That's why it's called a reverse. When you have a forward mortgage, you're actually paying down the balance each month. When you have a reverse mortgage, the balance is actually going up each month. The client does still have to pay taxes and insurance on the property. So there's no monthly payment, but they do pay taxes and insurance. And we have alternate products. These are non-traditional lending products. They come with a higher interest rate. They typically do not have mortgage insurance, and they can be full document loans. They can be asset related loans. They can be bank statement loans. But they're basically for borrowers that cannot obtain traditional financing. And then the last thing that I wanted to touch on briefly was double wides. Typically, you can go conventional FHA, VA on existing properties for double wides with a 620 or higher score. USDA does have a pilot program for used properties. However, I have not found any lenders who want to do the pilot program. So for USDA on double wides, you can only buy brand new and never lived in properties. Double wides must be on a permanent foundation and never moved. Both HUD tags need to be on the outside of the home, which show the serial number. These are metal plates and they're located on each end of the home. If it's a double wide, if it's a triple wide, it would have 3 tags. And the data plate, which is actually a paper sticker. Usually it's found inside the laundry room, kitchen cabinet, or bathroom cabinet. The home must have never been moved from anywhere except from the builder or dealer site to the place where it sits. Like, people cannot have bought them out of a mobile home park and moved them to a location that is not allowed for mortgage lending. And that is the conclusion of mine. Did I do good?
Yes,
Stayed under my 20 minutes. Does
Good.
anybody have any questions? Yeah.
We'll keep thinking about them because we'll have time at the end, like I said. Thank you,
All right.
Jamie.
Good.
All right, Mr. Adams.
Good morning, everybody. So I'm going to kind of close things out, talk about the process from the point where we get a contract from you guys to closing. So the first thing we're going to do is send out disclosures. So we get the contract now, we can lock the rate, we can get the disclosures, we have all the details of the transaction that we can actually, move forward, get all the stuff filled out. So we're going to send those out. One thing about this pandemic we've all been dealing with is it has made everyone more willing to electronically sign, which does speed up the process for us, for sure. There are still folks that want to come in and sit down and go over things, and that's fine. We're all happy to do that. But when people were willing to go in an e-sign, it does make it quicker. When we send that out, we're also going to ask for any remaining supporting documents. So they've talked about we got to have, whether it be bank statements, pay stubs, those kind of things. Some of those have to be updated. So we're going to say, hey, okay, at this point you're in contract, we need to go ahead and get the updated information. And hopefully they'll send those in quickly. That's one of the biggest challenges I think that all of us have experienced is delays on that kind of thing. So from that standpoint, you guys can encourage them to respond quickly when we ask for things, because that does make the process smoother for all of us. So at that point, we have everything. We're going to put the file into processing. Now I'm going to go back to something that David said. Every company has their own process. They have their own, this step, this step, this step. The steps are all there for all of us. Just they might be reversed, from one company to another as far as the exacts. We're doing a high level overview here. So processing is going to go through the file. They are going to order third-party things that are needed, such as appraisal, title, homeowners insurance, any verifications that may be needed, that sort of thing. So just to kind of touch on each of those briefly. So the RVAR had a class last month. Hopefully you guys attended for the appraisal, had a great presentation. I'm not going to get into that. I'm not an appraiser. They were appraisers. They did a great job. We all know the market we're in. It's a weird market right now. We're going to have things that don't appraise. We're seeing contracts come in way above listing price. When that happens, everybody I think everybody's hair raises on the back of your neck and goes, okay, we'll see. The appraisers I know are doing everything they can to continue making things work, but they have their guidelines they have to stay in. And that's why we use them, is we want to make sure, as David said, property value has to be there. So we have to verify that. So title work, that's another thing we order. We're going to get the title search ordered. As far as that goes, most of the time, you guys are going to have a title company already on the contract. If you do not, we're going to reach out to the purchaser and ask, because that's what Virginia state law says, is they have the right to choose. So if you guys don't have one on the contract, we're going to reach out to them. So it's always convenient when it's already on the contract, because it just saves a step for us. Because usually when we call them, they're like, I have no idea. I don't know who I want to use. So that helps us just in speeding the process up. Homeowners insurance, this is another point where you guys can really help the process. So many buyers wait. I'll wait, I'll get that done. And it's becoming a situation now where a lot, especially the bigger companies, are taking up to 2 weeks to get binders issued. So we really have to get those things ordered a little quicker than we used to. So you might be encouraging them to go ahead and make a decision who they want to use for their insurance. So that takes care of most of the upfront processing, that sort of thing. So the file is going to move into underwriting. So the initial underwrite does not require to have all of that information back, because obviously we'd be waiting too long to do that. They're going to underwrite based on a conditional version. So they're going to say, okay, well, we need the appraisal, we need the title work, we have to see all this, but we know that's coming. They're going to go ahead and underwrite the income and everything else to make sure everything else is good. And if there's any other documentation that the underwriter wants to request, we go ahead and get that requested at that point, instead of waiting until appraisal and title and all come back. The final underwrite is once everything is back. Okay, so we've got all the information, the complete file, and the underwriter goes through and reviews and checks off, and everything's great. And then I get to give you guys a phone call and give you that happy word, clear to close. That's what everybody's looking for. We want that. That's the last step before the clear to close is the final underwrite, where everything has been approved. All right. Then there's closing, and we're not there yet. Once we get clear to close, there's still some steps to go. The initial closing disclosure, initial CD, has to be sent out at least 3 days prior to closing. This can sometimes happen prior to clear to close. It depends. Again, that's a company thing. Some companies will send that out early. Some will wait until you have the clear to close. So that's going to be dependent upon the actual lender. Those initial closing disclosures, something that I always explain to people is, don't get upset if those numbers look a little off, because that is the initial closing disclosure. Unfortunately, that's the system that's in place. They're probably going to be off a little bit. We try our best as an industry to get it as close as we can for the initial, but inevitably it's going to be off a little bit. After that, it's going to get balanced with the title company and get the final numbers, and those numbers will be provided to the buyer prior to showing up for closing. And we have to verify like funds for closing. For example, what David talked about, like gift funds. If it's in a savings or checking account, we've already got those assets. We've already got that verified. If it's coming from, say, the sale of another home, That may not even close till the same day. We just have to verify those funds. That's a last minute thing, but those verifications have to be done. We do have to verify everything. That's kind of federally mandated at this point. We can't, like I said, can't have cash just show up. Those days are gone. I had that happen one time with a duffel bag. It was a long time ago, but nobody would touch that. The title company said, you carry that over across the street to the bank. And nobody wants that. So basically that's the process. I know I didn't take my time at all, but that's as simple as I could put it, and cover the basic steps. Are there any questions as far as from the time that we get the contract from you guys till we get to the closing table?
I know that Laura had an online
she-
question, and while
okay.
y'all are thinking about one in the room, you want to?
Yes, I think I've got two questions now. The first question, what is the overall breakdown of loans closed by type? In other words, are most conventional? I mean, what are you seeing? And you can look at David and Jamie to see if you all have the same answer.
Yeah, man, I don't know that I have a ratio in my head. I would say the conventional more so in the last 2 years than it was prior to that. For sure, with the rates dropping like it is, there's some definite, what Jamie talked about, some definite advantages as far as the mortgage insurance dropping off and things like that. So I would tend to say, that market share has gone up. You guys,
Agree.
okay.
It just depends on the.
Depends
It
on the
really
buyer.
does.
and
It
their
really does.
situation.
That's why there's all the different programs, is because it's not a one size fits all. It never is. It's never going to be, and it shouldn't, because everybody's got a different situation. So.
So I
hopefully
have a follow-up question related to that. Are you seeing any effects regarding financing type? And now that source of funds is a protected class under fair housing, the person that typed the question seems that VA and FHA contracts are seen as less favorable.
Not at all.
Mm,
Not at all. Why would they be?
Less favorable?
Yeah.
Why would they be less favorable?
Yeah.
For a seller, they're less favorable because it's an extra step with having that appraiser is going to come in and do more thorough than a conventional, as far as asking for things to be repaired. And that's what we're seeing.
No, the appraiser should be asking for anything safety or structural
Right.
on any loan program, not just FHA and VA. It's the same across the board.
I've never seen a conventional loan come in where they had a loan condition. I've never had one. A conventional loan condition that was a repair on a house. Always with my VA and government loans I had.
well, the
I don't know why,
government,
that's just my experience.
the government, that there are a few little nitpicky things that they're going to look at a little differently. It shouldn't be drastic, like Jamie said. It should be. I mean, if there's a major safety issue, that should be called out by any of them.
I got one, unconventional. I was surprised.
Yeah, I mean,
Yeah,
it's.
I haven't had one.
It's if it's a big issue. I mean, like FHA is known for peeling paint. That's one. Yeah, but that's kind of in fairness, you guys can kind of head that off early and say, hey, you need to paint this window sill. But anyway.
Since the collapse of the condos in Florida, we found out that the government programs have been going through condo association minutes of meetings and have been very, very, I mean, we had a step in a public area that was not part of the condo, by the way. It was a one-level condo. It was a patio home style. We found out that the steps, one set of steps that's never used, was not in good enough condition and had to be repaired before they could close on the loan. Are you seeing more of this?
If you plan on answering the question, can you
Yeah.
make sure to repeat any questions that we get in
Yeah.
the room so everybody can hear them?
Okay, so the question's about condos, and that's a pretty detailed question. I'll be honest, I don't do a whole lot of condos. Roanoke's it's not a beach area. We don't have tons of condos. Do one of you guys want to actually jump in on that? Specifically more than me?
I know as part of the process, when we're looking at can you hear me? Am I good? When we're looking at a condo, we do have a condo review team that does some research, like you mentioned, and make sure that, are there any pending lawsuits against the association? Are there any red flags such as you mentioned, about the deterioration of the building and so forth. And they have to pass on it, our condo team. So I don't directly get involved in that, but I do know that we do research the homeowners association and make sure that, everything's above board.
Right. Well, this wouldn't be the building itself, it's public area, public, common area.
But-
Okay.
So that leads to the basis of the homeowners association being sued should someone potentially fall on the steps or get hurt on the property. So part of the condo review is also looking at the assets of the association. Can they pay the deductible if they have a claim?
Mhm.
I mean, I do know there was a local condo project in the area that had crack at their garage. And we could not finance them because they couldn't find a contractor to come out. They didn't know when a contractor was going to come out. They didn't know how long it was going to take. And the buyer said, I'm done. How long are we going to wait on this? She had waited, I think, 3 weeks, and she said, I'm done with this. So depending on what the review shows, depends on what everybody's going to make a decision as to. Now, this one didn't actually show up on the condo review paperwork. It showed up on the appraisal. The appraiser made the note of the crack by the garage. And then the condo association came back and said, oh yeah, we feel it's a structural issue. And we're waiting on a contractor to come out. We haven't located one yet. So, when you're looking at a lender investor paying money and not knowing if the building's going to fall or not, you have an issue.
I guess it was going back to, since the collapse of the Florida condo, have you seen more stricter guidelines from FHA or any of these? Because that's what I was told was the situation in this case.
On the lender end, our guidelines have always been the same. So we're reviewing the condo docs, the insurance, the master insurance policy and things like that. On the condo association side, that's probably government regulation that's coming through directly to the condo association, not actually associated with mortgage loans. But I'm sure they are.
I had a similar situation with the local homeowners association. There was a pending lawsuit because of loss of life on the staircase. It was an elderly person. They ended up with multiple issues from the fall and passed away. So we were not able to assist that new client because there's always the question of, is that homeowners association will be able to withstand that lawsuit, because it was rather significant. So yes, it does come up.
So there are approved condo projects that are posted by Fannie Mae and by FHA. And if the condo project is not on the approved list, then you're going to what's called a non-warrantable condo. And of course, it's going to cost the buyer a little more money to buy a non-warrantable condo.
Well, this was already approved, but they did the review, I guess it's done. The most recent one came out with some points, so that's what it is. Thank you.
Thanks, Tim. All right. Tim, did you raise your hand? Oh, sorry. Anyone else have any questions? All right, Bob, what you got?
So I know you guys all have your people that you rely on for rates and stuff, and they all got their magic 8-ball that they ask questions to every morning. Where do you guys think we're going with rates? How long is it going to go up? Where is it going to top out at? Just a guess. And how long before we get it back?
All right.
Our 8-ball's not working.
Yeah, I didn't bring that. I didn't bring the magic 8-ball.
No, we don't have it today.
I have a feeling if you knew, you would not be a loan officer, you would be playing the market, helping all your friends become millionaires.
Exactly right.
This is true. This is true.
There's so many factors going on now. It's just.
I mean, they're
really
forecasted to go up.
Mhm.
How high, we don't know. There's so many factors that play into that.
This doesn't have anything to do with rates, but getting back to double wides. Can you, in terms of, like, for instance, I have a buyer who's a VA buyer, and they could go VA or FHA, and they've been looking at double wides. What are the conditions? As far as age, I know that obviously it has to be on a permanent foundation, but is there a difference in age of the double wide?
It has to be built after June, I believe it's 15th, 1976.
Okay,
And VA is probably going to be the way to go because it's going to give your borrower the lower payment because they won't have monthly mortgage insurance.
the VA, you said?
VA is the better loan for the borrower.
And rates usually are lower on the VA.
You want to make
Got
sure, you want to ask if it's on a permanent foundation. You want to make sure those metal tags are on each end and the data plates in the home showing the year, make, and model.
Right, okay. Because I mean, I thought it was 76, but I've heard conflicting, been told. So
And I would
just
ask
wanna
them
make
if
sure.
it's ever been moved, because if
Okay.
they say yes, you just need to find another double
Okay.
wide.
Okay.
And there are some lenders that have different dates that are newer than
Okay,
that.
yeah.
That's the general, federal rules, but there are some that I think I saw one sometime that was like in the 90s, 94 and up or something.
That's
So-
that's why I was asking, because the lender that they're using was saying in the 90s. And I'm
Okay,
like,
so
okay,
there are some out there that use that, there was some kind of a changeover in that time frame,
Okay,
and some go by that date too,
okay,
so.
okay. So either or,
that's- Yeah,
okay,
yeah, it's right there.
gotcha. Question?
Yeah, can you explain the difference? You're talking about permanent foundation. Can you go into a little bit more detail of what that is, please?
Oh, Bill, thank you for your
Thanks, Bill.
question. Okay, so with a permanent foundation, double wides are actually like a vehicle. You can drive them down the road. They come delivered on wheels with the tongue, which typically wheels and tongue are removed. And they usually go on mortar piers that have to be below the frost line. Can be on a brick or block foundation as well. But an engineer actually has to go out and certify that it is a permanent foundation. The titles have to be surrendered to the DMV and it has to be taxed as real estate.
Any other questions for anybody?
I have one other appraisal waivers. I'm seeing that. What can you give us on that? Because I know some issues that are pretty clear based on that the amount that's being brought. But is there any other issues that?
When we run the scenario through the automated underwriter system, it will come back. Freddie and Fannie have certain criteria for what they're looking for to be able to waive an appraisal. And so that would be part of that report, letting us know that appraisal is not required. Personally, if I were buying a home, I would want an appraisal done. With a refinance, that was a whole nother issue, and it was really helpful to be able to get an appraisal waiver. But that's something that it's based on the strength of the client, it's based on the strength of the transaction. All the ratios have to fall into place, great credit, that sort of thing. We would see it often if the loan to value was lesser. So even for a refinance or a purchase, if they're bringing more than a 20% down payment, that could sometimes trigger being able to do that. So just think that if the risk level is lower, there's always that possibility if you come back with a appraisal waiver.
Fannie and Freddie have actually been keeping data on the appraised values of the properties linked to the addresses. Right now, the issue that you're having is the housing prices are escalating, and escalating. So honestly, on my end, I'm not seeing a lot of property waivers. And we were told that drive-by appraisals were coming. And we were forewarned that the appraisers may charge the same amount for a drive-by appraisal as an interior inspection appraisal. Why, I don't know, but obviously they have to drive to the property and gas is high and all of that. But I've gotten some waivers, but it's not the typical thing to get an appraisal waiver.
I have received one just recently, and I was very shocked that I did,
On
but
purpose.
on a purchase. Yeah,
Like
And
you
they
say,
accepted
those
it.
people would want to have- Those people would want to have.
I would want to know. Yeah, I would want to know, but the client was okay with it, and so he took the waiver, saved him $560.
So to follow up on your question, I've lost, we've all lost some deals here in the past 6, 8 months. If you haven't, I need to sit down and talk with you. Of course, we all ask, what could my offer have been? What could I have done in my offer to make it more appealing to the client? And I've received a couple that said, hey, we had an offer that they already wrote in there, waive an appraisal. I said, well, how do they know they're getting an appraisal waiver without it going to the underwriter first?
Mhm.
They wrote it in their contract. The only thing I can figure out is they have already been through the process recently, and maybe it fell through, and they knew what that ratio was, and they knew they were gonna get a waiver. But that's what I'm hearing from some. They said, hey, they wrote it in contingency.
I'm saying the same thing.
Doesn't it just mean they're waiving the results, which means they'll bring.
No,
Waiving the.
they're not having an appraisal done on the home. No appraisal done, period.
But they
That
were
would be
getting
a cash
financed.
buyer.
Yeah,
But they weren't a cash buyer, they were financing. And I even asked the agent, I said, how do they know the bank is gonna waive that appraisal?
They don't, because finance can change.
They can-
Right.
My guess is if I went back and asked those agents, they probably said, well, we ended up having to get the appraisal. That's my guess.
Yeah, they rolled the dice.
Well, but wouldn't you have known from your lockbox entry whether someone entered the property?
Well, I had to buy side.
Oh, you
I
were.
was competing and I
Yeah.
lost. So I was
Okay.
asking, what could have.
And I've had the same situation. We've lost out.
Yeah.
Well, they had an appraisal waiver. Well, how?
Yeah,
How do they know?
I just think that's poorly worded.
Oh, it
Right.
must be.
You're in there.
I
They're
agree,
trying to
that's-
say, we're not going to, we have the money to go over. the
It could have been appraisal gap coverage. or
And I've
Could've
seen
been.
that.
Now what the lenders.
I think what Bob's saying is probably the case where they said, even if it doesn't appraise, we have the cash to make the difference.
The difference.
Right.
And I've
Well,
also seen where the reverse was true, that the seller agreed to go with the appraised value if it came back significantly lower. I guess it just depends on the seller. Are they willing to?
Yeah.
to
I mean, I'm specifically asking the question.
Yeah. I have seen home inspections be waived.
Oh,
That's,
yeah, all the
that's,
time.
which is
Every
not
day.
something that we really, recommend, but
Yeah.
you gotta do what you gotta do.
I saw something recently, a contract the other day where the buyer was going to pay the seller's closing costs.
Yeah, I'm seeing that too.
That is really.
That's flipping the whole scenario around.
Well, that's
isn't it?
only about $500.
1%. Yeah. Plus 1% grant for tax basically,
But yeah,
plus chump change.
And the second question I had, this is my last question, I promise. I've had this a couple times or a few years. It's not often. And for a veteran, when you're pre-qualified or pre-approving a veteran for the VA loan, if they don't have their COE, certificate of eligibility, and they're gonna have to, sign the document and send it off, it could be 7 to 10 days. How do you determine if they're pre-approved that VA loan if we don't have that COE back in time? Because I've had it where I've had to change the loan type, and then it would get a little sideways and messy, and then as it turns out, they didn't qualify for any other loan type. It's just, so how do we do that specifically for the veterans?
You don't send them off, it comes back electronically.
And usually very.
However it is, that's what I mean. When you submit it
Yeah, it's only a
electronically.
day or two. It
Yeah,
doesn't.
usually it's back in 24
Yeah.
hours most of
Yeah.
the time.
Well, I've had them take up to 7 days.
The only time I've seen that is when there's, like they used it in the past and it didn't get released correctly, or there's something like that with their records that they had to manually, the Veteran Administration had to manually go fix something.
Oh, that's
so
never
that they were
happens, right?
Well, there was
But-
one facility that actually burnt down.
Oh, I know,
And they
No, I
lost
get
the
it.
records.
My
But,
records
that's-
got burnt there.
That's the only time I've seen it take, and this has been the last probably 5, 6 years. It's usually back, I'll say maybe 48 hours, give it 48 hours.
Oh,
We
that's
got
a
it back
recently
pretty quick.
back soon.
Now, in fairness on that, what I always do is as soon as I find out that they're a veteran and they want to use the VA, give me your DD 214 and let me get that COE ordered now.
Exactly, that was my next question.
That
Or
just-
they can go to the POF building
Well,
and
that's
get it
Absolutely.
themselves.
Or they can sign into their e-benefits and pull it right up.
They know
We all
how.
have access.
Right.
If they know how.
If they know how to use a computer.
Yes, if they can use it.
Yeah.
Otherwise, Adam, Jamie, and Mr. Hikes will take care.
Yeah, that's right.
All right, well, thank you all for attending today in person and virtually. Please join me in thanking our presenters today for bringing their experience with us. Reminder of all the great events that we have to register for, both education and the fun stuff coming up soon. And thank you for your time. See y'all next time. Thank you.
Surprised you didn't mention the pet feedback.